The day Wall Street almost destroyed the world. Consider the possibility that the most significant financial crisis of the modern era was not a mere accident. Instead, it may have developed gradually over time, through a series of financial transactions, incentive by incentive, and risk by risk, until the global economy rested on a foundation that few comprehended. In 2008, banks collapsed, markets froze, homes were lost, and governments responded with urgency. However, underlying the crisis was a more profound cause: a complex financial system. This system was constructed by major financial institutions. It was driven by debt, profit motives, complex financial engineering, and the assumption that risk could be indefinitely concealed. This account examines the transformation of financial capital into institutional power, and how this concentration of power introduced significant systemic risks. For many years, banks were regarded as stable and unremarkable institutions. Their primary functions included accepting deposits. They issued loans to individuals and businesses. They also managed financial risk. However, significant changes occurred within the financial sector. Banks realized that substantial profits were not derived from traditional lending practices. Greater financial gains were achieved through the packaging, selling, insuring, and speculative trading of loans, as well as the creation of complex financial instruments that few individuals fully comprehended. Mortgages ceased to function solely as traditional home loans. They were transformed into securities. These securities were subsequently treated as investment vehicles. These investments were then utilized as collateral for further financial transactions. Subsequently, the financial industry introduced additional layers of complexity. These included derivatives. Credit default swaps were also developed. Synthetic financial instruments emerged as well. These financial products effectively transformed conventional home loans into instruments for global speculation. The documentary demonstrates that while financial innovation on Wall Street significantly increased revenues, it also interconnected financial institutions in ways that heightened systemic risk. Wall Street did not eliminate financial risk. Instead, financial institutions transferred risk elsewhere. They redefined risk using new terminology. Risk was also repackaged into complex financial products. These products were then sold to other market participants. This process created the illusion that risk had been eliminated. Credit default swaps were designed to protect investors from financial losses. However, these instruments also enabled banks and financial institutions to take substantial speculative positions on debt. The documentary explains that such financial innovations contributed to significant profits for banks, while simultaneously introducing systemic vulnerabilities. As the financial system grew increasingly complex, individuals became more likely to assume that others possessed a comprehensive understanding of its mechanisms. Bankers relied on quantitative models, believing these tools fully captured the risks involved. Investors assumed that rating agencies had thoroughly assessed and understood the risks. Regulators believed that banks possessed adequate understanding and control over the risks. Meanwhile, the general public remained unaware that the entire economy was increasingly exposed to interconnected and concealed risks. By the time the risks became apparent, banks had ceased to operate as independent institutions. They had become interconnected. The failure of one institution could precipitate the collapse of others. A disruption in the mortgage market could result in a freeze within the bond market. If the bond market ceased functioning, access to credit could be severely restricted. The disappearance of credit could lead to widespread business failures. For these reasons, the crisis extended beyond the confines of Wall Street. It evolved into a crisis affecting the broader economy. Many individuals lost their homes. Significant job losses occurred. Retirement accounts experienced substantial declines in value. Small businesses faced considerable challenges. Ordinary families bore the consequences of risks to which they had not consented. As housing prices declined, the financial system began to fail. Many loans defaulted. The value of mortgage-backed securities decreased significantly. The reliability of the insurance underlying these financial instruments was called into question. Interbank trust deteriorated. A breakdown in interbank trust leads to a halt in financial transactions. At this point, a financial issue escalates into an economic emergency. The government confronted a critical dilemma. Should the government intervene to rescue the financial system that contributed to the crisis? Alternatively, should it allow the system to collapse, thereby risking more severe economic consequences? The crisis marked one of the most contentious periods in modern capitalism. Banks received government support. Executives retained their positions. Markets were stabilized through intervention. However, millions of ordinary people were left questioning. Where was their support? This sentiment fueled widespread frustration. For many, the crisis exposed a harsh reality. Profits remained private. Losses were socialized. When Wall Street prospered, bonuses increased. When Wall Street faltered, the government intervened. Meanwhile, those not responsible for the crisis were left to bear its consequences. The most significant risk during the crisis was not solely greed. It was the underlying structure. The system prioritized short-term rewards over long-term responsibility. Traders could earn millions immediately by taking risks that could have severe future consequences. Banks could transfer risk by selling products to others. Rating agencies could endorse securities without bearing full responsibility for the outcomes. Regulators responded too slowly as the system grew increasingly complex. The lesson is simple. When financial systems lack accountability, those in power act recklessly. Wall Street nearly destroyed the economy, not due to ignorance, but because of systemic issues. This occurred because intelligent individuals created a system that incentivized overlooking risks. The crisis demonstrates that unstructured wealth leads to speculation. Innovation without responsibility results in harm. Power without accountability ultimately imposes costs on others. The next time someone claims, "This time is different," remember the events of 2008. Systems may appear effective and resilient until they fail. Money, power, and risk are always interconnected. The crisis was not an accident. It resulted from incentives built into the system. Before you go, remember this. Most people spend years working for money without ever understanding the system controlling it. This channel exists to break down the hidden mechanics of wealth, power, markets, investing, and the economy in a way most schools never teach. If you want to think differently, invest differently, and understand the world beyond the headlines, subscribe, because the next financial crisis will not warn people before it arrives. And the people who understand the system early usually survive it differently.